Welcome to vTalkInsight, Risk Sentiment Daily for December 13th, 2025. Markets are navigating a late cycle mix of resilient growth, powerful AI investment, and rising valuation and macro risks. Let us unpack how that balance is shaping risk appetite across assets today. Across assets, today's tone is cautiously risk-on against a clearly late cycle backdrop. Equities are still hovering near record levels, volatility remains contained in the mid-teens, and recent pullbacks have been shallow, but investors are becoming more selective about where they take risk. On one side, resilient growth expectations through 2026, a broadening equity rally beyond mega-cap technology, and ongoing AI-driven capital spending underpin confidence in the medium-term earnings path. On the other, labor data are cooling, consumer surveys look pessimistic, valuations are rich across much of the equity complex, and geopolitical tensions are inching higher, all of which argue for smaller position sizes and a greater focus on quality. Positioning reflects this tension. There is clear evidence of rotation into small caps, value, cyclicals, financials, and even select thematic areas like cannabis, yet many asset managers are running higher liquidity, staying underweight corporate credit, and parking meaningful cash in very short-dated treasury products. The result is a market that still leans toward taking risk, but with an explicit buffer of cash, high-quality credit, and defensive sectors in case the macro narrative or AI optimism stumbles. A key bullish force is the broadening equity rally and rotation away from a narrow group of mega-cap technology leaders. Small caps are outperforming, with the Russell 2000 setting fresh highs, while value stocks have sharply beaten growth over the past several weeks despite still trading near the cheapest end of their 25-year relative valuation range. Leadership is extending into financials, industrials, transports, materials, and even select consumer names. Industrials have been upgraded after breaking out of a multi-month range. Materials have moved from underweight to neutral as investors anticipate an economic upswing, and regional banks are expected to benefit from a steeper curve, solid credit quality, and lighter constraints on leveraged lending. Improving breadth reduces dependence on a handful of AI beneficiaries and suggests the equity advance is backed by a broader economic narrative, not just a single theme. At the same time, some of the rotation reflects profit-taking in crowded tech winners and a search for pockets of more reasonable valuation, so the durability of this trend will depend on ongoing earnings follow-through from cyclicals, small caps, and value sectors. The second major support is a broadly supportive Fed and liquidity backdrop, even if the messaging is mixed. Official projections now embed stronger growth, stable unemployment, and lower inflation out to 2027, which together point to policy gradually moving from restrictive toward neutral, while market-based inflation expectations have improved and are now more benign than consumer surveys. Beyond the policy rate, the central bank has paused balance sheet runoff earlier than many expected and stepped up Treasury bill purchases after signs of minor funding strain, reinforcing the perception of a strong liquidity backstop. Treasury's own tilt towards shorter-dated issuance further reduces duration risk and modestly eases financial conditions, supporting risk-taking in equities and in high-quality credit, even as some managers prefer to stay underweight spread product for now. There are caveats. Some officials are reluctant to front-load cuts while inflation remains above target and market expectations for easing still run ahead of the Fed's published path, leaving room for disappointment if data fail to soften. However, if unemployment were to rise meaningfully above the central bank's projections, investors see scope for more aggressive cuts, a steeper curve, and lower short-term yields than currently priced, making upcoming labor and inflation prints critical for the rates and equity narrative. Another powerful bullish driver is the AI-led capex and productivity boom that is working its way through the real economy. Estimated AI-related capital spending is already in the hundreds of billions of dollars annually, with data center providers, power equipment makers, and semiconductor capital equipment companies reporting multi-year backlogs and no signs of cyclical slowdown. Companies like Schneider Electric expect double-digit annual growth in data center demand over the next 5 years, while leading chipmakers report AI backlogs and revenue trajectories that imply very strong growth into 2026 and beyond. At the same time, supply constraints in critical components and power infrastructure are extending visibility for key suppliers, supporting earnings for industrials, utilities, and parts of the energy and materials complex that enable this build-out. This story is not without friction. Permitting, energy bottlenecks, and questions about real-world monetization are creating delays and raising the bar for future projects, while policymakers are still struggling to deliver a coherent national AI and energy strategy. Even so, governments increasingly describe AI as a central growth driver, and the structural demand for compute, connectivity, and electrification suggests the investment cycle could persist for many years, provided the sector continues to demonstrate tangible productivity gains in earnings reports. Balancing these supports is a clear bearish driver: elevated valuations and rising fragility around parts of the AI complex. Risk assets are effectively priced for perfection, with global equities near highs, margins and growth assumptions ambitious, and AI-related names discounting very strong productivity gains and demand through at least 2026. Recent events illustrate how quickly sentiment can shift when those assumptions are questioned. Oracle's aggressive leverage and heavy dependence on large AI contracts have led to a sharp widening in its credit spreads, while disappointment around Broadcom's backlog and guidance, as well as margin concerns on big custom chip deals, have triggered double-digit drawdowns and spilled over to wider AI infrastructure names. Defensive sectors outperformed during the latest tech sell-off. Cash-like products have seen large inflows, and many managers report holding more liquidity and running underweight positions in both investment-grade and high-yield credit to keep dry powder for potential dislocations. Some investors view the recent pullback and tighter financing conditions as healthy discipline rather than the end of the AI story, but with valuations broadly elevated and private credit also exposed to tech-heavy borrowers, the scope for idiosyncratic shocks and greater dispersion across single names is rising. A second important headwind comes from softening labor data and signs of consumer stress. Monthly job gains have slowed markedly from last year and are projected to decelerate further. The quits rate has fallen back to levels last seen a decade ago, and unemployment has started to edge higher, all of which point to less confidence among workers and employers. At the same time, consumer sentiment remains at cycle lows and is expected to deteriorate across income groups, including higher earners, even as headline spending has so far held up. Rising costs for essentials such as healthcare and insurance are driving greater use of credit cards among lower-income households. Spending is rotating toward value-oriented retailers, and several retail categories saw month-on-month declines, suggesting that the consumer pillar of the soft landing narrative is becoming more fragile. If labor market deterioration accelerates, it could force a more aggressive policy response and bring forward rate cuts, which might support asset prices, but would also signal a weaker underlying economy. For markets, this mix argues for close attention to upcoming employment and retail data, not simply for their impact on the Fed, but for what they may reveal about the sustainability of corporate revenue growth and credit quality into 2026. The third bearish driver is rising geopolitical and policy risk, with Europe at the center of several fault lines. Moves to freeze Russian assets indefinitely, debates over how to use those funds in Ukraine negotiations, and warnings from NATO leadership about preparing for potential large-scale conflict have all raised the stakes, even though European bank equities do not yet fully reflect the risk that asset seizures could undermine confidence in the sector. Beyond Europe, escalating sanctions and land threat rhetoric around Venezuela after an oil tanker seizure add uncertainty for energy markets, while in the United States legislative deadlock over healthcare subsidies creates the possibility that tens of millions could lose support, with knock-on effects for household finances and healthcare-related equities. Layer on top a muddled regulatory path for AI and energy infrastructure, where executive actions are likely to face legal challenges and permitting delays threaten to constrain power supply, and it is clear that policy shocks remain a meaningful tail risk for both growth and market volatility. To sum up, risk sentiment remains cautiously risk-on, supported by a broadening equity rally, a still accommodative Fed and liquidity environment, and a powerful AI-driven investment cycle. even as valuations and labor data remind us the cycle is advanced. At the same time, fragility in richly valued AI names, growing signs of consumer and job market strain, and a noisy geopolitical and policy backdrop argue for a greater focus on dispersion, balance sheet strength, and the timing and tone of incoming data. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.